Hi everybody, welcome to Chapter 4. For Chapter 4, Part 1, I want to do two problems together because I think that they can be a little bit tricky. Just tax in general is tricky, right? I'm sure that you're discovering that, but there's some especially tricky stuff that's going on with this chapter. So the first problem I want to do, I have shown for you here, and also the two problems that I'm going to do together with you for Chapter 4 are also problems that you're going to do for your homework. So I'm going to do the problem that's in the book, and then you're going to do a similar version of the problem with different numbers. Okay, so I'm working on problem 4-2. So you can either just follow along here on your screen, or if you happen to want to have your textbook in front of you, I'm on page 4-47, and it's problem number 2. Okay, so let's just look at the problem here. So during 2018, Tom sold some Sears stock for $10,000. And they tell us that the stock was purchased 4 years ago for $13,000. And then the problem goes on to tell us a bunch of other stuff that happened with some different investments. We're just going to handle each one at a time. And then the other thing I'd like to point out that I think would be useful for you to refer to as we're following along in this problem, and then also to refer to when you're working on your problem. If you go to page 4-10 in your book, that section there, 4-4b, that's the calculation of a net capital position, and then there's those 4 sections. That is what you need to know in order to get to the right answer on this problem. So first of all, this Sears stock is definitely a long-term hold. The stock was purchased 4 years ago. 4 years ago is longer than 1 year. So whether there's going to be a gain or a loss, it's definitely going to go in that long-term category. So we want to classify everything as either long-term or short-term, calculate gains and losses, and then we'll go through this process of netting things together to get to what the answer is going to be. Okay, so for this Sears stock, we bought it for 10. We bought it for 13 and we sold it for 10. Obviously we lost money, right? So what we sold it for minus what we bought it for equals, we have a $3,000 capital loss, and it's a long-term capital loss. Okay, let's look at the next thing they tell us. They tell us that Tom also sold Ford Motor Company bonds for $35,000. The bonds were purchased 2 months ago for $30,000. Okay, those were only purchased 2 months ago, so that's definitely going to be a short term. So that's going to go in our short term category. So let's figure out what's going on there. So this is Ford Motor. And let's see, we bought the bonds for 30. We sold them for 35. So what we sold them for minus what we purchased them for is a gain, right? But it's going to be a short-term capital gain. Okay. Next we've got Home Depot. Home Depot stock purchased 2 years ago. 2 years tells us long term, for $1,000, was sold by Tom for $2,500. So he made some good money on that one. So since that's long term, I'm going to stick it up here because I want it to be next to my other long term thing, since I know I'm going to have to net long term stuff together and I'm going to have to net short term stuff together. Home Depot. So it was sold for $2,500 and he bought it for $1,000. So that is a long-term capital gain. So we have a long-term capital gain, a long-term capital loss. Oops, forgot to put the answer in there. Okay. What else we got? That's it. There's only 3 things going on in this problem. Sorry, I thought there were 4. Okay, so following along with those instructions on page 4-10. So first they told us capital gains and losses are classified into 2 groups, long-term and short-term. So we have them in 2 groups. There's long-term, there's short-term, they're separated. Long-term capital gains are offset by long-term capital losses. So we have 2 long-term things going on here. One is a gain, one is a loss. So let's net those together. So we have a net long-term capital. Is it a gain or a loss? It's a loss, right? Because this number is bigger than this number. The loss is more than the gain. So we have a net long-term capital loss. And it is $1,500. So it's $3,000 minus $15,000. It's the difference between these two. Okay, and we don't need to net anything for our short term because there were only one of them. So going back to page 4-10, we don't need to do number 3. So then number 4 tells us if step 2 above results in a net long-term capital gain, it is offset by any net short-term capital loss, resulting in either a net long-term capital gain or a net short-term capital loss. So step 2 above, did we have a net long-term capital gain? No, we have a net long-term capital loss. So let's keep going. If step number 2 results in a net long-term capital loss, which is exactly what we've got here, it is offset against any net short-term capital gain, resulting in either a net long-term capital loss or ordinary income. Oops, and I forgot to put the answer down here too. What was I thinking? Okay, so we are going to net these 2 things together right here. And if we have a $5,000 gain and a $1,500 loss, that's going to give us a $3,500 net short-term capital gain. So I just took the difference, 5,000 minus 1,500 gives me 3,500. And it's a net short-term capital gain because that was the bigger number. And then also, as you know from reading along in your textbook, that short-term capital gains are also classified as ordinary income. So that's why you see on page 4-10, after we did all that, we either would end up with a net long-term capital loss, which we didn't, or ordinary income. So short-term capital gains are classified as ordinary income. So, have any of you guys ever heard of a day trader? I actually did some day trading back in a long time ago. It seems like a previous life, but makes me sound old, but it was probably like 15 years ago. There was a lot of stuff going on with the market, and I was a little bit interested in doing that at the time. So day traders, they'll buy and they'll sell stock, sometimes many times in one day. Or maybe they'll buy and they'll only hold for a short period of time. They're not holding on to things for the long term. So people that are doing that sort of thing, day traders, that's considered by the IRS to just be their job. So they're taxed at ordinary income. They don't get the tax benefits that are associated with long-term capital gains. So just something interesting to know. There's a lot of day trading that starts to happen when the stock market becomes really volatile. Volatile meaning that the stock market is going up and down by really big amounts. If you're looking at the Dow and you're seeing it go up by 800 points or down by 800 or 1,000 points in one day, oh my gosh, those are really, really big swings. And there can be some opportunity to make money and also lose a ton of money too. So it's Okay, now let's look at problem number 7 in chapter 4. So this actually isn't a complicated problem. I think the one that I just did, problem number 2, can be just a little bit tricky, but it's not too bad. To be honest with you, tax is kind of tricky in general and it gets a bad rap. But if we just break things down into little pieces and look at real world examples, most of it's not as scary as it sounds. It's just, it can seem really complex because the rules are constantly changing, and that's kind of overwhelming, right? It's like you learn something and then they decide 3 years later that it's going to be done a totally different way. It's honestly ridiculous that the people in Washington that are making these rules can't just figure out a good way to do it that's really fair for everybody, and achieves their goals and just stick with it. Politics in this country are just absolutely ridiculous right now. So on behalf of them, I apologize. Okay, so let's look at number 7. So number 7 is kind of a really cool problem because this kind of a problem definitely may end up showing up in your own personal life. In fact, it just recently showed up in my own personal life because my husband and I just sold a house that was a primary residence of ours, and there was a significant gain, and we didn't have to pay tax on it. But I had to go through the process of figuring out what my gain was and whether or not it was taxable. So super useful. Okay. Larry Gaines, a single taxpayer. It's important to pay attention here to the fact that he's single, because if he was married, there's something else that would be different. It wouldn't affect the answer, but always pay attention to those things. Is somebody single? Are they married? Their filing status. He's 42 years old. He sold his personal residence on November 12th, 2018 for $148,000. So he lived in the house for 7 years, and the expenses of the sale were $9,000. So those are like his closing costs and realtor fees and all that stuff. He has made capital improvements of $7,000. So that could mean a whole bunch of stuff. It could mean maybe he remodeled a bathroom, maybe put on a new roof, although $7,000 is really cheap for a new roof. Maybe he built a deck that's attached to his house out in the backyard, remodeled the kitchen, all sorts of stuff. And then they tell us his cost basis in his residence is $85,000. So he bought the place for $85,000. Let's first look at part A and B, because part C we'll look at next. So they want us to tell them the realized gain and the recognized gain. So both of these words start with like RE, and they both say gain. So like, what is the difference? And this is an important difference to know and to understand if you're going to be an accountant, which I think that most of you probably are if you're taking this class, because you're definitely going to hear this word realized versus recognized when you get into intermediate accounting classes. And accountants that like to sound like they're smart, they'll use some of these kind of words too, but they do really mean something that's important. So a realized gain, that's the amount that you actually realized. That is something that you got. It's in your pocket. The sale of this residence closed, and this is a real gain. A recognized gain is one that is formally recognized on a tax return, or is formally recognized on an income statement, on financial statements. So sometimes we will have gains that are unrealized. Sometimes they will be realized. The difference between unrealized and realized is that has that particular sale of whatever it is, a house, an investment, a company, whatever it is, has it actually closed? If that transaction is actually closed, then you will have a realized gain or a realized loss. But the sale has to have already gone through. You don't own that house anymore. You don't own that company anymore. A good example that I can think of as an unrealized gain. So unrealized means that you're still holding on to whatever this asset is, and it hasn't been completely sold. So just think of maybe you bought a stock. You bought Amazon stock. So I bought Amazon stock, let's say, for example, for $800, however many years ago. Last time I looked at Amazon, which wasn't all that recently, it was trading at like $1,800. So if I bought something for $800 and now it's technically worth $1,800, because if I sold it right now, I would be able to sell it for $1,800. That's a $1,000 gain. But you can't say that you actually have a $1,000 realized gain because you haven't sold that stock. You're still actually holding on to it. So it's an unrealized gain. It's worth $1,000 more. That's a gain, but it's not realized yet, because the stock market could open up tomorrow and everything could fall apart and everything could crumble, and we could find out that Amazon's been lying on their financial statements, and their stock could become worthless, and then you don't really have a gain. So that's the difference between realized and unrealized. So I wanted to take a minute and talk about that. And then the IRS is the one that tells us under what circumstances we have to recognize a gain on our tax return, and then also give them some money sometimes, potentially. Or sometimes FASB, who writes all of the GAAP, all the generally accepted accounting principles, they're the ones that write all the rules that tell companies when they have to recognize items on their financial statements. So one of the many things that you learn as you're going through accounting is this something that I have to put on my financial statements? What is the calculation that I have to go through in order for that to be done accurately? So that's a lot of the stuff that you're going to start to work on when you get to intermediate accounting. Some of it gets to be a little bit complex, but it's really interesting and important to know. So there's my little side note about that. Okay, so let's look at our realized gain. I want to pull up my little paper here. So let's calculate the realized gain. So what did he sell it for? He sold it for $148,000. And let's see what we can subtract from that. The expenses of the sale are $9,000. We get to deduct that because it cost us money, or it cost him money to sell this house. Remember, those are all the closing costs and stuff. Those capital improvements of $7,000, those don't have to be classified as gain because he actually had to put $7,000 into his house to remodel the bathroom or add the deck or whatever he did. So we're going to subtract $7,000 for capital improvements. And then also we need to subtract what Larry originally paid for the house, which is $85,000. And that will give us his realized gain. He actually made $47,000 on the sale of his house. So that's the answer to part A. Now let's look at what is his recognized gain. So the IRS has this rule that if it is his personal residence and he hasn't claimed an exclusion on a personal residence in a specific amount of time, that sometimes the IRS changes. Single people get to exclude up to $250,000 gain from the sale of a personal residence. He only has a gain of $47,000, so his recognized gain on his tax return that he has to pay taxes on is $0. Yay! That's one of the things that the IRS did that was kind of nice, right? Why does the IRS do that? Why do they let single people exclude up to $250,000 and married people exclude up to $500,000? You know, because there's two of them, so they get to have $250,000 apiece. The reason why they do that, one of the reasons, and I'm sure there's other reasons that maybe I don't even know, but the reason I'm going to give you makes a lot of sense. The government wants their, at least theoretically, the government wants their economy to be strong, and they want to have a mobile workforce. So a mobile workforce is somebody that is able to move locations for their job relatively easily. if people have to worry about, oh my gosh, if I sell my house so that I can move to Pennsylvania for this new job, because there's a shortage of people like me in Pennsylvania, whatever my job is. They need me in Pennsylvania. My country needs me in Pennsylvania because I have an important job there that I need to do. That's an important part of our economy. If people have to stop and worry about paying taxes on the gain of a sale of a house when it's relatively small, they're maybe going to be less inclined to go and take those jobs that they need to take. So the IRS, again, wants to have this mobile workforce. They want to make it a little bit easier for people to people to be able to move around. And if you're a homeowner, that can kind of make you feel stuck. So that's kind of the why for why they do that. And then the answer to part C is super easy. What is the adjusted basis of the new residence? So if we wanted to, I could see some of you trying to look at this problem and make it all complicated and go, oh my gosh, I have to do something with all these numbers, adjusted basis. That's like a really complicated thing. Oh my gosh, wait till you ever take a corporate tax class. Adjusted bases are going to make you scream. The answer is just the cost of his new residence. He bought a new residence at a cost of $148,000. That is the basis of his new residence. Okay, that's the end of chapter 4, part 1.